Hello and welcome to week 4 of the TickerTank weekly video coaching series. This week we're going to be talking about TRIN and we're going to be talking about gaps. I want to start with TRIN and then we're going to move over to the computer, finish up on TRIN, and talk about gaps. So TRIN, it's a pretty simple principle, but it's very important. It's a great tool to have in the belt along with all the other tools that we've been talking about and some of the tools we're going to be talking about in the future. TRIN is mainly utilized for day trading. So if you're day trading equities, futures, if you have a short-term swing trade, you just want to keep an eye on the market breadth to make sure that you're in a safe position with your swing trade. You want to keep an eye on TRIN. TRIN is short for Arms Index, which is also short for Traders Index. So TRIN, Traders Index, Traders Index, TRIN. Basically where it came from. A reading of 1 is neutral in TRIN. A reading below 1 is bullish, and a reading above 1 is bearish. Pretty simple stuff, right? So, it's not uncommon to see a very volatile intraday trend chart. So I just kind of drew an example out here, and we'll look at a real-life example when we move over to the computer. But, so for example, we've got 1 right here, which is the neutral point. The x-axis is going to be your time, so we're looking at intraday, probably maybe a 1 minute, 2 minute, 5 minute chart, something along those lines. Just pretend. So 1 is neutral. You can see we've got a few points where we've neutralized here in this chart, but we spiked up initially, so the push to the upside is a bearish indication. So we're seeing more volume going into declining stocks than advancing stocks. And when it pushes down here, we've got a bullish reading. We're below 1, so it's bullish, meaning there's more volume going into advancing stocks than volume going into declining stocks. Now, the lower the reading, the more bullish the breadth from the trend. So basically, the lower the reading, the more volume is going into advancing stocks and outpacing those declining stocks. And the higher the trend reading, the more bearish, and the more volume that's going into declining stocks, outpacing the advancing stocks. So typically trend stays between about 0.6 and 2 roughly, but I've seen it go as high as like 3, 3.5, and I've seen it go down to like 0.2. But it's going to stay in a range. If you see it go outside of a specific range, it's a good opportunity for you to take a look at the market. If it spikes up real high, it's possibly a good opportunity to actually buy, because it's spiking out of its range. It's probably going to pull back pretty quickly. And same goes for the downside. If it pops down to 0.2 or 0.1 real quick, probably a good idea to maybe short or exit and take some profits on a day trade, something along those lines. So just something to keep in mind. Let's take a look at the stuff in the computer. We'll talk about gaps. So let's take a look at a visual of TRIN. If you see here over in the left-hand side of my screen, I've got TRIN highlighted. This is TRIN. TRIN is short for Traders Index. We already covered that. So take a look at TRIN. We'll pull up the chart, and you can see at the moment it's 1.77. If we go into an intraday chart, one day, we'll just do a 1 day, 1 minute chart. You can see TRIN moves, quite a bit during the day. And recently we've been seeing some bearish action in the stock market. So we mentioned a push above 1 in TRIN is a bearish indication. Push below 1 is bullish, and a reading of 1.00 is neutral. Somewhere between 90 and 110 is pretty much the neutral range. But you can see here recently we've seen some pretty sharp moves to the upside, indicating bearish activity intraday. So up here we were in the 2.6 to 2.2 range quite a bit, and over here we're in the 2.4 to 2.00 range. But you can see here, basically I just wanted to give you a visual of TRIN. Our neutral zone is right here in the 1.1 to 0.9 range, and then anything below that is bullish, anything above that is bearish. And it does go much. I've always thought it was kind of strange that it goes from 0 to 1 and then from 1 to theoretically infinity. So there's so much room on the upside for crazy bearish prints or crazy bearish indications, yet there's only 0.99 room to the downside for bullish prints in TRIN. I don't really have an explanation for that, but I do have a visual here for you, and that's all we were promising. All in all, I utilize TRIN on a daily basis. I keep a very close eye on it, so I think it's important that we cover it.
And that's really all there is to it. We've already talked about all we needed to talk about on the whiteboard, and now you've got your visual. So I want to move on to gaps. Gaps are specifically gaps in price action, and you typically see them on shorter term charts, 2-day, 3-day charts. But we've got bearish gaps, and a bearish gap is when the market opens, or a specific stock opens higher than its previous day close. So you see a gap in the price action. For example, if a stock closes at $100 on a Thursday and then opens at 110 on Friday, you'll have a 10-point bullish gap. Flip side, bearish gap is when a stock opens lower than its previous day close. So you've got a specific situation where the same stock closes at $100 on Thursday, opens at $90 on Friday, 10-point bearish gap. Now, that's the simple part of gaps. There's 3 types of gaps. You've got a breakaway gap, a runaway gap, and an exhaustion gap. A breakaway gap is the first gap that you see in a longer term chart that indicates a stock is either going to run to the upside or possibly run to the downside. And the direction of that breakaway gap indicates whether it's bullish or bearish. So if you have a bullish breakaway gap, you're going to have a previous day's close and a higher next day open, indicating a potential push to the upside. So we've got CSTR here. This is the 6-month chart of CSTR, and basically this kind of gives us a good chart to go over all of the different options here. First of all, let's look at a bearish gap. Here is a bearish gap. We're just sticking to bearish and bullish gap first. There's a bearish gap. We had a close below, or I'm sorry, an open below the previous day close right here, so you can see that gap in the price action. And here's a very obvious bullish gap. We have an open the next day higher than the previous day's close, and that was due to earnings in both cases. But we also have example of a breakaway gap, which is right here. We had a nice gap to the upside in the stock price, and you can see that was the start of a really nice upside move. So if you'd noted that gap and then noted some continuation above this, say, resistance level right here at 30, then that would have given you a good opportunity to get bullish on CSTR and take advantage of some of this upside momentum. Now, a runaway gap is a gap that happens after a breakaway gap and indicates potential continuation in the direction of the initial breakaway gap. So if you have an initial bullish breakaway gap, like the case here in CSTR, then your runaway gap is going to be the next gap that you see in the longer term chart that indicates potential continuation in that initial bullish direction. So here we have our breakaway gap, as we already pointed out. Let me get the oval tool. So here's the breakaway gap. Had some nice uptrending, and then we have this potential runaway gap. So I say potential because you don't really know if it's a runaway gap until you see a few days of action, or a few weeks really. So in this case, we had a nice push to the upside and then a really strong pop here, but it kind of petered out right below the 60 level. Made a little bit of a double top, which we'll discuss later. But and right now we're actually seeing a pullback into this gap, which brings us to our third type of gap, an exhaustion gap. An exhaustion gap is when you think a gap is potentially a breakaway or a runaway gap, but it tricks you and you get a fill of that gap. So in this case, we haven't seen a complete gap fill, which would take the price back to around 38.20 in this case. Right around, let's see, that day's close was 38.21. So yeah, price action would go back to 38.21, but we're darn close to this complete gap fill here. Just have about 4 more points of downside pressure, and you'll see 4 or 5 more points, and you'll see a complete gap fill, making this runaway gap that we use as a runaway gap example a exhaustion gap. So another example, let me give you an example of a fully filled exhaustion gap. We've got Lulu here, L-U-L-U. And L-U-L-U, you can see we had this nice gap to the upside here, but it turned and burned, and we had this complete gap fill right around this area right here in this price action. So all in all, it's pretty simple. Those are the 3 types of gaps. The basics are you got bullish gaps and bearish gaps. And then your three major types of gaps are breakaway, runaway, and exhaustion. Breakaway gaps are the potential start of a big move to the upside. Runaway gaps are a potential continuation of that initial big move indicated by the breakaway gap. And exhaustion gaps are when either breakaway gaps or runaway gaps fill after several days of trading, basically indicating that no, that wasn't a breakaway gap, or no, that wasn't a runaway gap. This stock is tired of moving to the upside or tired of moving to the downside, depending on the direction of the gap. And you're likely to see continuation in that exhaustion gap trend. In this case of Lulu, it actually bounced off of the support level. But in the case of Coinstar, back here, if we do see a complete gap fill, you may see continuation to the downside. Who knows? Time will tell. But that does it for Week 4 TRIN and gaps. And as always, if you have any questions, feel free to email me at support@TickerTank.com. And you can always call the office at 502-384-6554. Until next week, you guys take care.